Hi, I'm Jared Nelson, and welcome to Markets in Minds, the show where we break down big macro themes into simplified trade ideas. This week, we are going to look at a concept that can highlight why and how markets are performing the way they are, and which areas may be the next big thing. That concept is fund flows, or weight of money. Financial markets are driven by many factors, but one of the most important of these is supply and demand. Prices rise when a market or instrument is in demand. However, prices tend to fall when the supply of that market or instrument outweighs the demand for it. Prices move because the market is trying to find a new equilibrium level where buyers and sellers, or supply and demand, can be matched off against each other. The supply of and demand for financial instruments can come from many quarters, but among the most influential sources are institutional investors, such as fund managers, insurance companies, pension funds, and the like. These businesses manage hundreds of billions of dollars of investments for themselves and for underlying clients. They have to decide where to invest those billions of dollars, and they do so via a process called asset allocation. Asset allocation is a top-down approach to investing that seeks to balance risk and reward, to diversify portfolios, and generate returns that are in line with the investment mandate of the portfolio. The role of an asset allocator is to create a strategy that meets the investment mandate, and one which produces at least the minimum desired return, and ideally will beat that benchmark. Asset allocation decisions are made at a strategic level. This means big picture, long-term multi-year, or even multi-decade planning. There is also dynamic asset allocation, which is a medium-term strategy that tries to adjust portfolios to reflect changes in things like the economic backdrop, in interest rates, or even the emergence of new markets and investment opportunities. Asset allocation decisions are also made at a tactical level, where investments are bought and sold as stocks and sectors swing in and out of fashion over shorter-term timeframes. All three of these asset allocation strategies can create investment flows, but the dynamic and tactical asset allocations are the most active. Asset allocators often talk about being underweight, overweight, or market weight in an asset. What they mean here is the amount of money they are allocating to a particular asset, compared to what the market believes is the appropriate weighting for that asset. Quite simply, when an investor is overweight on a particular stock or sector, they are putting more money into that investment. And when they are underweight, they're putting less money in, or even taking money out of it to redeploy elsewhere. It's those movements that create what are known as fund flows, and there is a whole section of the market that tracks, catalogs, and reports on those flows. The jobs of both asset allocators and fund flow analysts have been made much easier over the last 2 decades by the emergence of ETFs, or exchange-traded funds. Today, there are ETFs that track pretty much every investment strategy, asset class, or type of instrument. Changes to the assets under management within this ETF reflect the flow of funds into or out of this strategy, and this data is updated and published daily for most ETFs. That means that we can get a clear insight into where the money is flowing to and from, and we're talking about serious amounts of money here. For example, last week saw $8.47 billion flow into ETFs that track the S&P 500 index, while $2.57 billion flowed into ETFs tracking the price of silver. Bank of America reported that this was the largest weekly flow of money into silver ever recorded. Almost $2.5 billion was invested into lower quality but high-yield U.S. bonds, while $1.1 billion flowed out of higher quality but lower-yielding investment-grade U.S. bonds. The S&P 500 index rose by 4.6% last week, its best performance since November, while silver prices spiked by as much as 20% before falling back during the period. These flows move markets. 20 years ago, it would have been almost impossible for private investors to access this kind of information, but now you can find this data online using simple search terms. TrackStar IQ, our proprietary search tracking database, allows us to take this process one stage further, and we can see what ETFs institutional investors have been researching. ETFs that track the S&P 500 and silver were among the most researched funds last week. However, there was also interest from Wall Street pros in U.S. small-cap equities, emerging market stocks, and long-term U.S. government bonds, as well as clean energy and oil prices. By keeping track of fund flows and institutional searches, we can get a good idea of exactly what the institutional money is interested in, where it's heading, or coming from next. That's all we have time for this week. Remember, make sure you do your own due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.